In 2026, the global economy is facing something it has not confronted in quite some time, a full-blown oil supply shock. This is a scenario where crude oil availability drops sharply while demand remains robust, sending prices soaring. For everyday consumers, this translates into a very real drain on household budgets. For businesses, it means rising input costs across nearly every sector. And for investors, it creates a challenging and confusing environment. This is certainly not the first time the world has been through something like this. History is full of similar episodes, from the Arab oil embargo of the early 1970s to the disruption triggered by the Iranian Revolution in 1979, to the Gulf War's impact on crude markets in 1990, to the commodity boom of 2008. Each of these events rattled markets and tested investors' resolve. What is happening right now? The current situation stems from a geopolitical escalation involving Iran, which has responded to military pressure from the US and Israel, not just through conventional means, but through an economic countermeasure, blocking the Strait of Hormuz. This narrow maritime corridor is one of the most critical choke points for global oil transportation. Because the strait's geography creates extremely tight shipping lanes, it is relatively easy for Iran to threaten or disable any vessel attempting passage. The result has been an immediate halt to tanker traffic. The effect on oil prices has been immediate and dramatic. West Texas Intermediate crude futures have jumped from around $64 to roughly $100 per barrel, while Brent crude has surged from $68 to over $110 per barrel. Because petroleum is a foundational input across so many industries, the ripple effects are widespread. Gasoline prices have risen sharply at the pump. Aviation fuel costs have climbed, forcing airlines to increase fares. Shipping and logistics have become more expensive, pushing retailers to pass on higher costs to consumers. Even products like plastics, fertilizers, and chemicals are seeing upward price pressure. The stagflation problem. What makes oil shocks particularly dangerous for the broader economy is their dual nature. Normally, inflation and economic weakness pull in opposite directions. You would expect high inflation in a growing economy and low inflation in a weakening one. Oil shocks break this pattern. They simultaneously push prices higher while dragging economic activity lower, a condition economists refer to as stagflation. This unusual dynamic also weakens the Federal Reserve's standard toolkit. Raising interest rates addresses demand pull inflation, where too much money chases too few goods. But an oil shock generates cost push inflation, driven by supply constraints rather than excess demand. Higher interest rates cannot fix a blocked shipping strait. They can, however, slow down an already struggling economy, making the policy choices even more difficult for central bankers. What should investors actually do?
Opinion on commodities. If we're in an oil stock, it's because we think it offers a lot of value at this price, but it does not mean that we think the price of oil is going up. If we thought oil was going up, we could buy oil futures, which we actually did once. But very seldom, very, very seldom, would we have any opinion on what any given commodity would do.
And this is temptation during a crisis like this is to take action, to try to forecast where oil prices are headed, to position into energy commodities, or to make dramatic changes to a portfolio. But this instinct is almost always counterproductive. Trying to predict the short-term direction of a commodity that is being driven by geopolitical decisions that haven't even been made yet, is not investing. It is speculation. And it is a game where very few people consistently win. The problem with commodities is that even experts with deep industry knowledge rarely have a reliable edge in forecasting short-term price movements. And in the current environment, the outcome depends largely on diplomatic and military decisions made by a handful of governments. There is simply no analytical framework that gives an investor a meaningful advantage in that arena. Oil futures, in that context, are closer to a bet on geopolitics than an investment in business value. Stick to businesses, not bets. The more durable approach is to focus on what can actually be understood and evaluated. Individual companies with real competitive advantages. When oil prices spike and inflation rises, not all businesses are equally affected. The ones that suffer most are those with thin margins, heavy capital requirements, and weak pricing power. The ones that tend to hold up best are those with strong brand loyalty, low capital intensity, and the ability to pass higher costs on to customers. Think about a business that sells a product people will continue buying regardless of macroeconomic conditions, and that does not require constant massive reinvestment just to maintain its operations. These are businesses whose value is embedded in their brand, their intellectual property, or their deep integration into customers' workflows. They can raise prices modestly each year without triggering significant customer loss, and they do not need to build new factories or acquire expensive equipment just to keep pace with inflation. Software companies are a strong example of this. A business whose product is deeply embedded into how customers operate, think enterprise software used daily by thousands of employees, has enormous pricing leverage. When costs rise, they can increase subscription prices, and customers are unlikely to switch because the disruption of doing so far outweighs the cost increase. Revenue goes up, incremental capital investment stays low. That is a business built for an inflationary environment. Consumer staples companies with powerful brands operate similarly. A business selling a product that people have bought out of habit for decades at a price point that remains accessible even after modest increases has real pricing power. These companies don't need to spend billions on new infrastructure to grow. Their brand does most of the work. The capital light advantage. This brings up a concept worth examining closely: the relationship between a business's capital requirements and its ability to create value during inflationary periods. A business that can grow revenue significantly while only needing to reinvest a small fraction of its earnings back into the company is in a fundamentally stronger position than one that must constantly spend just to stay competitive. Consider a business that grows its revenue tenfold over several decades, but only needs to invest a relatively small amount of additional capital to achieve that growth. The gap between what it earns and what it needs to reinvest flows directly to shareholders as value. That type of business, capital light, brand driven, with consistent customer demand, holds up well across economic cycles, including oil shocks. By contrast, capital-intensive industries like energy production, mining, utilities, or heavy manufacturing are often at the mercy of inflation. Every time input costs rise, they have to spend more just to maintain existing operations, let alone grow. Their margins get squeezed from both sides, rising costs and limited ability to pass those costs on. What this means for your portfolio? The practical implication of all this is fairly clear. During a period of oil-driven inflation, the most important thing an investor can do is evaluate their holdings and watch list through the lens of pricing power and capital efficiency. Ask, for each company, can this business raise its prices without losing customers? Does it require heavy ongoing investment just to stay competitive? Is the demand for its products or services durable across economic cycles? Companies that score well on those questions tend to be the ones that preserve and grow investor wealth through difficult macroeconomic periods. Companies that score poorly are more likely to see their margins eroded, their earnings under pressure, and their valuations fall. The current environment is undeniably challenging. Oil shocks have historically contributed to significant inflationary episodes. But turbulent markets also tend to create mispricing, situations where a fundamentally strong business is being sold at an unreasonably low valuation simply because sentiment is negative. For investors willing to do the analytical work, that is where opportunities emerge. Final thoughts. The key takeaways are straightforward. Avoid the temptation to speculate on commodity prices. That is a game where the outcome is driven by factors nobody can reliably forecast. Focus instead on identifying businesses with genuine competitive advantages, strong pricing power, and low capital requirements. Those are the businesses that tend to navigate inflationary environments most successfully. If you want to go deeper on how to identify and evaluate these kinds of businesses, including how to test for competitive moats and assess whether a company is trading at a reasonable valuation, that is exactly what we cover here at the Purple Analyst. It's worth taking the time to sharpen these skills, especially in an environment like this one, where the difference between a resilient business and a fragile one matters a great deal. Stay rational, stay focused on fundamentals, and remember that volatility is not just a risk, it's also an opportunity for those who are prepared.